if we have the fewest number of people on unemployment in recent history, while wages are rising, while people can finally work from home in their pajamas, why is the Federal Reserve Bank so worried about the job market if we have so many jobs out there? Well, it's because the Federal Reserve Bank is actively working to fight inflation, and this inflation fight comes with consequences, and some of these consequences are layoffs. And now some people are saying that something around 4 million Americans could lose their jobs because of the Federal Reserve Bank's fight against inflation. At this point, you're probably wondering why this random guy on YouTube is making this video about some random economists who believe that 4 million Americans can lose their job. Well, this is where you want to know who these economists are, because these economists work for none other than the Federal Reserve Bank. Yes, the Federal Reserve Bank economists themselves are now predicting that we could see something like 4 million job losses as the Federal Reserve Bank continues to fight inflation. And now you also want to take that with the perspective that this is coming from the Federal Reserve Bank, because remember, the Federal Reserve Bank doesn't want to panic people. They don't want to make people worried. And in all of 2021, they kept saying that inflation is transitory. Even into 2022, they said that inflation is not that big of a deal and that they have it under control. And now the Federal Reserve Bank is starting to get much more aggressive, or at least they say that they want to get much more aggressive to fight inflation, even if that means we have to endure some economic pain. And some of this economic pain, according to the Federal Reserve Bank, is job losses. And according to the Federal Reserve Bank, this could amount to something like 4 million job losses in the coming months. This is where it pays to have some education on how economic cycles work, because at the bottom of a cycle, the bad thing about being at the bottom is this is where people don't have jobs, everything is down, everyone's losing money. But the upside is you have a lot of upside, because now you're at the bottom. This is where you can see things start to turn around, and you have a lot of upside from the bottom to the top. And likewise, at the top, this is where everyone feels rich. Everyone has a job. Everyone's making money. Everything is going up and everything looks good. But the downfall of being at the top is that's where you also have the most to lose, because now you're at the top, and that's where things can start to go down. Now, nobody can predict when you're at the top, but this is where right now we're in a situation where our economy and our asset classes have really been propped up because of the Federal Reserve Bank, because they have printed so much money over the last couple of years, and this has produced an economic bubble, not just in the stock market, not just in real estate, not just in cryptocurrency, but in our general economy. And so now, in order to cool down inflation, they need to literally prick the bubble. And in this case, they're doing that through raising interest rates and through doing something called quantitative tightening. And one of the consequences of this fight on inflation is job losses, because now when you raise interest rates, it makes doing business more expensive. Your corporation has to pay more money to borrow money, and this then makes it more difficult to do business, because now your costs are higher, which means businesses spend less money, which means they have less money for employees, which means people lose their jobs. If people lose their jobs, spending slows down. And if spending slows down, less people are buying that extra guac at Chipotle, which means Chipotle is making less money, which means they have less money to invest in more employees. And so you can start to see how it becomes this negative economic spiral, which is one of the things that the Federal Reserve Bank is actively trying to avoid. But now we're in such a unique situation that inflation is so hot that inflation by itself is now hurting the economy, because now the Federal Reserve Bank has printed so much money, they've heated the economy so much that now the prices of things have gone up significantly faster than wages, and people are now having to cut back on their lifestyles, not because we're in an economic slowdown, but because we are in an inflationary induced economic slowdown. Yes, the economy is slowing, but it's not slowing just because the economy is slowing. It's slowing because we have printed so much money, and now we have seen this disproportionate amount of wealth go to the people who understand money, and the people who don't understand money are being left behind, because the people who don't understand money are being burned by inflation. And this is where now the Federal Reserve Bank is trying to reverse everything that they did by pulling the money out, by pricking the bubble, and they're saying that this is going to have consequences which include job losses. Now let's talk about what you need to do and what you need to be aware of. But before we do that, if you want an easy way to stay up to date on what's happening with news like this, because we have covered the story in great detail in Market Briefs, which is my free financial newsletter, where every day, Monday through Friday and Sunday, my team is breaking down what's happening in the stock market, real estate, crypto, inflation, and the global economy. It's a fun, witty, easy to read email. I get tons of emails of people saying that this is the only email they look forward to reading every single morning. I promise you, you're going to love it, and the best part is that it's completely free. So if you want to join Market Briefs and stay financially educated, I'll put the link to how you can join Market Briefs down in the description below. I was talking to a friend of mine this morning as I was walking to the gym, and he's a dentist and he has his own dentist practice, and he was talking about the economy and the labor market in the sense that he's having a tough time finding somebody to answer phone calls and essentially be a receptionist, work the front desk at his dentist office. He says that before this whole pandemic, he was paying something like $13 to $15, maybe $16 an hour. And now he's been putting up ads for something like $17 to $21 an hour for a front desk worker, a receptionist, a secretary, something like that role. But he hasn't been able to find anybody. He said that he's had some interviews and people are coming back saying that they want $30 an hour to answer phone calls. And he's saying that it's very hard for him not to staff because he doesn't know what the right amount of money is. And this is the economic labor market environment where we're seeing wages. A lot of people want more money. Why do they want more money? Because, well, the cost of everything is so much more expensive, and so people are saying we need more money. And this is now the cycle that the Federal Reserve Bank is trying to avoid. This is what happened in the 1970s and the early 1980s, where the price of things kept going up, which caused then people to need more money. So now people had to now ask for more money from their jobs because they need more money for the job in order to survive. And now they get more money, and then when you get more money, this causes the cost of business to go up, causing the price of things to go up, causing people to need more money, causing what's called the wage price spiral. And this is what the Federal Reserve Bank is actively trying to avoid, because this is the situation that led to a lot more inflation in the 1970s. It caused the price of things to grow significantly faster than wages in the 1970s, and it caused a huge disparity between the haves and the have-nots in the 1970s into the early 1980s, because inflation disproportionately hurts the people who don't understand money, like I talked about a little bit earlier in this video. Right now, we are in a demand-heavy economy. Business owners want workers. People want nice things. People want cars. People want homes. People want to buy vacations. People want stuff. And people have the money for it still. Not as much as 6 months ago or 12 months ago, but still, it's the demand-heavy side of economy right now. This is causing a different type of teeter-totter in the economy where you have all this demand that's outpacing the supply, causing the price of things to go up. It's causing wages to go up. It's causing the price of things to go up. It's causing homes to go up. It's causing grocery prices to go up because we're still facing this economy. Now, the Federal Reserve Bank keeps saying that the cause of this inflation is supply chain issues. We have a bunch of supply chain problems causing the inflation, when in reality, the supply chain issues are a byproduct of the inflation. You print a whole bunch of money, give it to people, give it to businesses, give it to corporations. What happens? People and businesses have money to spend while nothing is being produced. So you create a whole bunch of demand, and now everybody wants to go and buy things, but businesses can't produce. They can't get enough workers. They can't find enough things. And so now you create the supply chain issue, and this then produces the price of things to go up from wages to things, because they all go hand in hand when we talk about inflation. And so now what the Federal Reserve Bank is trying to do is they want to flip the demand and supply curve. Well, actually, they want to equalize it. But what ends up happening many times, it ends up flipping. But what they're trying to do is they're trying to equalize the supply and demand curve by popping the bubble. They want to raise interest rates. They want to make borrowing money more expensive. They want to cause some businesses to go under. They want to cause more layoffs, which would mean more supply. Not just more supply of products, because now people can't afford all the stuff out there, causing the price of things to hopefully go down, or at least not go up so much higher, but also then increase the amount of workers out there. That way business owners can also afford to sustainably hire more employees. And so this is the cycle that you have to understand, where over the last few years, we've been facing this demand-heavy part of the economic cycle, and now the Federal Reserve Bank wants to flip it, where then it can become equalized, but the risk is that it becomes supply-heavy. And the easiest way to understand that is just think about what happened after 2008, where everybody wanted to sell their home. Homes were on the market because of foreclosures, but nobody wanted to buy. It was a supply heavy market, and those type of supply heavy markets cause the price of things to come down. So this is kind of the situation where the Federal Reserve Bank is trying to figure out what to do. They're trying to fight inflation, and the risk of fighting inflation and the consequence of fighting inflation is layoffs. This is where you want to protect yourself. Make sure you're working for a good corporation. Make sure you have some savings put aside. Make sure you don't just rely on one stream of income. Learn some other skills. Keep learning, keep educating yourselves, and make sure that you can take care of yourself and your family, and don't just live paycheck to paycheck because you can, because you believe that the stream of income will always be there, because you always want to have some cash put aside for your savings, your investments, and never spend more than what you earn. We printed the most amount of money ever. We have a bubble economy right now. This is a fact. But you know what? We want a safer investment. We don't want the dollar.